So thank you so much for joining us today. We're here to talk about UK tax and what you need to consider when leaving the UK. We've got quite a lot of attendees, so hopefully this is a subject that everyone's really interested in. So what you may have seen is we've already lost Lizzie again. I think that's an IT issue. Hopefully she'll be able to join back later in the meeting. My name's Alex. I work in our Holt office of Larkin Gowan. I lead our international private client team. My focus is on residency, domicile and foreign tax issues, and I also do a lot on property taxes.
Hi everybody, my name is Bridie and I am an assistant manager in our private client team alongside Alex. I started in the medical team with Larkin Gowan, moving over into the personal tax team where I can specialise in residency and offshore issues.
We've got an agenda up of what we're going to talk to today. We're going to start with some basics. What do we mean by residence? We're going to go on to something a bit more complicated and talk about dual residence and double tax treaties. And then the importance of residence and what stays taxable in the UK. I'm going to pick up one of my favourite topics about remote working overseas. We've seen a lot of that post-COVID. And then there's a few other potentially non-tax points that we want to talk about as well before we'll open it up to Q&A. Next slide, please.
Righto people, so let's kick off with the basics. What do we actually mean by residence? So next slide please. Residence, as I'm about to explain, is not necessarily exactly what you think it is on the face of it. So residence is where you would deem to be living for tax purposes. This is what we're going to be discussing. So this is not a simple case of where you consider yourself to be living, where your only or main home is, where you work, where you were born, where you're a national citizen. They are not the things that we look at when we consider whether or not someone is a resident. So when we consider whether someone is a UK resident for tax purposes, broadly, which is going to be my favourite word throughout this webinar, because there are always exceptions. This is actually a matter of how many days, midnights specifically, you spend in the UK during a tax year, the reasons you are in or outside of the UK, and what your future intentions are and what your past circumstances are. Those are the three sort of main things we look at when considering your tax residency, whereas, yeah, residence is not the holistic things I previously mentioned. So when assessing your residence for tax purposes, we look at the statutory residence test. The statutory residence test has 3 automatic tests that make you UK resident. There are 3 automatic overseas tests that make you overseas resident. And if you don't fit into any of those 6 tests, you then consider the sufficient ties test, which is far more grey area to feel your way through it. So because this is a webinar focusing mainly on exiting the UK, we're going to be looking at the automatic overseas tests in more detail. So the first automatic overseas test that we look at is a day count one. So if you were resident in the UK for at least one of the 3 preceding tax years and spent fewer than 16 days in the UK, automatically overseas resident. If the first one applies to you, the second one won't, because that says if you were resident in none of the previous 3 tax years and you spent fewer than 46 days in the UK, you would again be automatically overseas resident. And the third one, which is what I think is going to apply to most people when exiting the UK, would be working full-time overseas. So that is where you average 35 hours a week, broadly, during the year without any significant breaks, and spend fewer than 91 days in the UK during the tax year, and the number of days where you work in the UK is less than 31.
Can I just flag here, Bridie, that point about working full-time overseas without any significant breaks? Because lots of people, I find, know the conditions that you must work 35 hours per week on average, you must spend fewer than 91 days in the UK and fewer than 31 work days. But no one ever understands or knows about the significant break test. And a significant break is when you take a break from work of 31 days or more, apart from reasonable annual leave. Well, for some people, it might be reasonable to take a 31-day break. You might have people who work month on, month off. So because it's not black and white like the day count tests, we have real problems with this particular part of it, where does somebody meet it or don't they?
So yeah, Alex makes a really good point there. So Alex, if I was self-employed and I decided I've worked so hard in the last couple of months, do you know what, I'm going to take 40 days holiday because I'm self-employed, to set my own holidays, and I'm going to go and enjoy myself for a bit and then come back to work. Does that fall into, I'm still self-employed, I'm still working, I've just decided to take a big chunk of time off for a break? Would that still, how would that fall into the significant breaks clause?
Yeah, I think that one would be really hard to argue, because it's probably not reasonable for a self-employed person to take 40 days off at a time. So it's probably not reasonable annual leave, unless it's parenting leave as well. Actually, there you go, there's another exception. But yeah, the likelihood is that you could meet your, work clearly 35 hours. You could meet your day counts in the UK, but because you've had a 40-day gap from overseas work, you've failed the full-time work overseas test, and that might trip you from being non-resident to UK resident.
Right, really important point to think about there for sure. Next slide, please. So the test that we were just talking about there apply to a full tax year. So we're talking 6th of April to 5th of April the following year. Chances are, if you're exiting the UK, if you leave on the 6th of April, happy days, makes everything so much simpler, but that very rarely happens. Job contracts start at different points, life gets in the way. So people leave at various points in the year. So we can't always apply a full year's conditions. In this event, we look at split year. So this treatment will usually apply in a year where your pattern of presence changes and we're talking about leaving the UK. So splitting the year is where you identify the relevant point of exit. That is not always the day you actually leave the country. So from that point up until the end of the tax year, you are considered a non-resident, and from the start of the tax year up until the relevant point, you leave the UK, you're considered a UK tax resident. So whether or not you can split a tax year is a question of facts. It's really not a given. There are some very specific cases, 8 cases in fact, of which 3 apply to exiting the UK and 5 apply to entering the UK. Now, the 3 cases that would apply to leavers would be case 1, which is starting full-time work overseas. Not what it says on the tin, very specific things and conditions that have to apply. Case 2 is the partner of someone starting full-time work overseas, so who qualifies for case 1. And the 3rd case is ceasing to have a home in the UK. So yeah, they're very specific conditions, and where an individual qualifies for split year treatment, the claim isn't optional because it will always be more beneficial. So it is it's an intrinsic, non-optional treatment.
Great, thanks. We've got an example to illustrate this. This is actually a real life example, but I've changed all the names and dates and places, obviously for confidentiality. But this just goes to show what you think is right and is going to happen sometimes just isn't according to the legislation. So Misty is a UK resident, born in the UK and lived here all her life. She was offered an 18-month secondment to work in the UAE from the 15th of May 22 to 14th of November 23. She returned to the UK after that, back to the home that she'd maintained while she was working abroad temporarily. She came to us with some advice to check everything had been done properly. She was pretty sure everything was tax exempt because UAE is a tax-free territory. All her work had been carried out there. She didn't spend more than 91 days back in the UK throughout her secondment because she only came back for a fortnight at Christmas to see her family. So next slide, please. Okay, breaking it down. Misty left the UK on 14th of May 2022. and then arrived in the UAE the next day to start her job and rented an apartment out there. Can we click on, please? Great. Looking at the tests for 2022-23, that tax year on a standalone basis, she's going to be automatically UK resident under the second automatic the second automatic UK test. This is the one which says you must have your only home in the UK for a period of 30 days in the tax year. And because she was here at the start of the tax year, 6th of April through to 15th of May, she's got a period of 30 days when her only home was in the UK. So 22-23 is a UK resident year. We then need to see whether we can split under case 1, 2 or 3. Case 2 is not relevant because her partner remained in the UK, so we're only looking at case 1 and case 3. Can we click on, please? Thank you. The conditions for case 1, she's working full-time overseas. She's doing that sort of 35 hours a week, so that's great. She's not spending the 91-day or prorated for split year cases. She's not exceeding those thresholds for days back in the UK. However, one of the conditions of case 1 is that you must work full-time overseas for at least a full tax year. And because she only left partway through 22-23 and then came back partway through 23-24, there is not a full tax year when she is non-resident. And so she fails case 1 split year. Similarly, she also fails case 3 because she kept her UK home throughout that time. Her husband and family remained in that property. So case 3 simply couldn't apply. What that meant is that all of that income earned out in the UAE for that 18-month period was actually taxable in the UK, and would have had to file 2 tax returns, 22-23 and 23-24, to pay that UK tax. And because the UAE is a tax-free jurisdiction, there were no foreign tax credits to offset that UK amount that was due. So that wasn't a great conversation to have.
So, yeah, that is a perfect example of where things, like even establishing a residency, things seem so straightforward, but really when you look at the tax consequences and the tax treatment of it, it's really not. So this is a great example, and let's look at what Misty could have done differently to change the outcome of what happened. So what she could have done, firstly, was the date she actually went to the UAE. I appreciate not everyone can dictate when their contracts start and so on and so forth, but say, for example, had she left to go to work overseas on the 1st of December and finished her contract on the 30th of May, case 1 conditions would have been met, and this is because she would have been outside the UK for a full tax year and qualified for a full tax year. So the 18 months itself wasn't the problem. It was when it fell into the tax year was the issue. Another point was, again, this would be the archetype. This would be incredible if all tax things started on the 6th of April. Everything would be fabulous. So yes, had she left on the 6th of April, spent fewer than 16 days in the UK during the first tax year, we wouldn't have even had to worry about split year. She would have qualified automatically under the first automatic test, and then she wouldn't even need to stay out again for another year because the first year would have been done. So under an automatic test. So would have made a huge difference. Extend her contract. A lot of job offers do allow you to do that. Failing that, find full-time work just to fill the gap that would make the difference, even if it's for 6 months. You don't have to stay in the same job for the case to apply. You just need to be working full-time without any significant gaps, as we discussed. So finding another job, if it falls into those conditions, absolutely fine. So that is another option for her. And the last option is rent her home in the UK. Just by owning a property, it doesn't mean you have a home in the UK for tax purposes. A home is not what it says on the tin. Again, it's very much if it's available to you and it is used or can be viewed as a home to that person. If she's renting it out on a commercial basis and has no access to the property, it isn't a home. So she could have actually qualified under case 3. So this is a great example again of where this would have been a really proactive and preemptive approach to Misty's job overseas and could have saved her a lot of money. But when you're on a reactive basis trying to work out what happened, it's a retrospective issue that can't be undone, I'm afraid. So yeah, always plan ahead, always seek advice before you go, because it can make a huge difference.
I think that's a message that we're going to be talking about a lot in this session, is that we can help if we know what's going to happen and we can be proactive and plan. But when people come to us after something has happened, after the event, the rules are the rules. Much as we would like to change them, we really can't. So yeah, I'm not sure I'd want to kick my partner and family out of their UK home just to make sure that I saved
how much money
salary.
Would you save?
So that's one of those ones where maybe, you know, circumstances dictate the tax, but clearly if you'd had a single person and they had an empty house, they could have rented it out to meet that condition. Great, thank you. So I'm going to talk about dual residence, and please bear with me because I'm aware this is a bit more of a complicated subject, and we'll try and keep it as simple as possible for you. But it is perfectly possible to be a resident in 2 countries at the same time. And whenever you have this situation, you need to establish which country is going to be your treaty resident country or not. So I'm just waiting for the slides to catch up. Thank you. So the treaty resident country is the one that has the primary taxing rights. It's the one that you pretend you are tax resident in. And the treaty non-resident country only has limited taxing rights. It's the one you pretend you are non-resident in. So you can be UK tax resident, but treaty non-resident. And the way you decide which country has that primary right or not is laid down in the treaty under what's called tiebreaker tests, and they're common to every treaty. You look at, first of all, you look at permanent home, and if you've got a permanent home in just one country, you stop there, you don't look at anything further. But if you've got a home in 2 countries, then you look at where your centre of vital interest is. The best way I can describe centre of vital interest is this is where your life is. It's where your friends and family are, maybe where you work, maybe where you socialise, maybe where you're registered to vote, maybe where you have your pets and your belongings. It's sort of what most people, if you asked, oh, where do you live? You know, where's your home? They'd be able to say. Habitual abode is where you normally live, and that is normally where you spend the most amount of time, but it doesn't have to be. And if those 3 really can't point to one country clearly, then you get down to nationality. But I have to say, most people stop at the second one, centre of vital interest, if they're living between 2 countries. That's where we stop. So we've got a couple of examples on the next slide.
I will just quickly say, Alex, on that, just while I'm thinking about it, whilst you can be resident in 2 countries at the same time, you can also be resident nowhere for a tax period if you spend a very period of time in various countries throughout the year and you actually don't fall into any of their sort of residency rules, like a true nomad, then you can be resident in no country whatsoever. And as a blanket rule in those scenarios, you would just be taxed in those countries for the income that arises in those particular territories, because you don't belong as a resident to any country in particular to be taxed your worldwide income. So yes, you can be both resident in 2 places and or nowhere. So that is just something to be mindful of. That is achievable.
Yeah. And actually the places I've seen that before is where somebody breaks residence in the UK on the 5th of April, and then they've moved to a country where residence doesn't start, say, till the 1st of January, and they've maybe done some travelling in between. Usually it requires you to not to put down any permanent roots anywhere. So you've got to have a period of time where you're living a pretty nomadic lifestyle.
Yeah.
Great. Great. So just 3 very typical examples. Mr. A has permanently relocated to Australia, moved 1st December 2023 to take up full-time employment there, not returned to the UK since, and therefore he's non-resident in the UK from that date. Very typical. Somebody's dual resident. So Mrs. B, she's retired and she spends 6 months of the year in the UK and 6 months of the year in Cyprus. She has a home in both countries and is tax resident in both countries under each of their domestic rules. So in that scenario, we look at the double tax treaty tiebreaker tests. Permanent home, okay, well, she's got one in the UK, one in Cyprus. So then let's look at centre of vital interests. Where does she consider her life to be? Now, if she lives in the UK, really, and actually she just spends the winter in Cyprus, it's extended holiday because she's retired, and why not, then the centre of vital interest is probably in the UK. But it may be a bit more than that. It may be that she's got a very settled way of life in Cyprus and in the UK, in which case we'd then look at habitual abode. Well, habitually, she's spending 6 months in the UK and 6 months in Cyprus. So that may be one where we have to drop down to nationality. But as I say, it's not common to see that. An international commuter is the other typical example we have. So I've got Dr. C, who lives in the UK with his family, but he works 4 days a week in France and 1 day a week in the UK. He has a house in both countries and is tax resident in both the UK and France under their domestic rules. And again, looking at the treaty tiebreaker, permanent home in both countries, but in this case, his centre of vital interest probably really is the UK. That's where his family is, that's where his friends are, that's where he spends his off time. He's only going to France to work. Okay.
So where do we find out what to do with all this income when people are dual resident, non-resident, have income coming from overseas or the UK when you're non-resident, is the double taxation treaties. So most countries worldwide will have a double taxation treaty or agreement with the UK. They can be found here at this lovely link. The treaties provide a comprehensive breakdown of the most common types of income sources. It is not exhaustive, but it will cover most income sources and gains, and it will show and dictate the treatment between the two territories. So
yeah, I'm gonna jump in here and say treaties are relevant not just when you've got somebody that is tax resident in 2 countries at the same time, but also if you've got somebody who is tax resident in the UK and has foreign income, or is non-UK resident with UK income, then the treaties come into play in those scenarios to dictate who has the taxing rights to those. And as Bridie says, it can be that one country has the taxing rights entirely and the other country has to exempt it, or one country can tax a little bit of it, but it's subject to any limitation. So yeah, complicated.
Yeah. Super complicated, absolutely. So ultimately, once your residency has been established, that is numero uno, primary issue. You then need to consult the treaty to understand how your income's going to be treated. And completely, again, achievable. Sometimes treaties don't exist between these country, between the UK and the country that is being considered in any scenario. So in the event there is no treaty and there is cross income situations, then for example, a non-UK resident will continue to be taxed on their UK arising income and UK gains, because there's nothing to say otherwise, and a UK resident will continue to be taxed on their worldwide income and gains and receive a credit for any taxes paid overseas or under domestic rules, because there's nothing to dictate otherwise. So yeah, it would go down to sort of ground level.
Bridie, have you seen many countries that don't have treaties?
The last one off the top of my head that I know is Brazil. I think it's being written and considered, but not currently in existence.
Yeah, most countries have got a UK treaty.
Yeah, it does.
Great. Great. Okay, so thank you for bearing with us through that slightly more complicated section. We're now going to explain why residency is important. So typically, UK residents are subject to UK tax on their worldwide income and gains, whereas non-residents are only subject to UK tax on their UK income and gains. As a general rule, the income arising in the UK remains taxable. So these will be sources such as property, income, bank interest, dividends, remuneration for work that is actually carried out in the UK, and we're going to talk a bit more about that later in our remote working section, and government pensions. So these are the things we often see are still subject to tax in the UK. Capital gains are a bit different. And the general rule for that is that gains deriving from UK land in any form remain taxable. We'll talk a bit more about gains later because they are a bit different, a bit more complicated. And always, this is quite a broad brush list, and every time you have to check the treaty. Thank you.
So just picking out a couple off that list that we can talk about in a little more detail that we would see regularly. Property income. So common scenario is you're going overseas to work for a period of time, not permanent. You keep your UK home, rent it out while you're not there. Very common situation. So if you rent out property in the UK as a non-resident, the rent you receive will be taxable in the UK because it is sited there and generated there, and potentially in the country you are a resident. Again, we go back to the treaties that will tell you the ins and outs, but the UK will have the primary taxing rights as it is situated and arising in the UK. Just as really an aside, HMRC operate a non-resident landlord scheme, which means that letting agents and tenants are required to deduct 20% tax at source from rental income before it's paid over to you. And when you complete your UK tax return, which you'll have to do for receiving property income, then it acts as a credit against any taxes arising at the end of the year. In some situations, if your total rental income for a period year does not exceed your personal allowance, we'll talk about personal allowances in a minute, then you can opt to have your income received gross, your rental income received gross, but that is an application as well. So it's really down to your particular situation and circumstances. So in my experience, this is really poorly understood. Very few people and letting agents don't really go along with this because it's just something that is extracurricular for a lot of letting agents and tenants and landlords. So we would always recommend that anybody that goes overseas and rents property in the UK completes an NRL1 form. Write that down.
Thanks. Personal allowances, yeah, really important because this is your £12,500 roughly tax-free. If you're a British or ENA national, you're entitled to that tax-free personal allowance wherever you live. So if I went and moved out to Mexico, I'd still be entitled to my tax-free personal allowance. But if you're not a British or EEA national, then there is a very set list of who is entitled to it or not. So, for example, Mr. Mina is a South African national who came to the UK to work for many years. He never applied for British passport or citizenship, and he decided he would like to retire early and move to New Zealand to live out the rest of his days. He rents out his house in the UK. However, HMRC says that Mr. Mina is not entitled to a personal allowance because he would only get it if he is a resident and a national of New Zealand or a resident and national of South Africa. But what he is a resident of New Zealand and a national of South Africa. So he doesn't get the tax-free personal allowance and he has to pay full UK tax on his rental income. Mrs. Mina, on the other hand, I didn't put this into example, but Mrs. Mina, if she's a Brit and she moves to either South Africa or New Zealand, who cares? But she's a Brit, so she does get her personal allowance. So husband and wife have both got the same income, one of which has to pay UK tax and one of which doesn't. Thank you.
very good example on personal allowances. It's really important. It is really important to understand and establish that. So I'm just going to quickly talk about government service, which again may not be as all-encompassing from the title as it sounds. So government service has a separate article in most treaties between the UK and other territories, because this is work carried out under the Crown and generally considered to be taxable in the UK wherever these duties are performed, which is actually quite contradictory to most of the things we're going to be telling you here when working abroad. So usually this encompasses careers such as the forces, civil servants, police officers, so on and so forth. We'll go to talk about pensions in a little more detail later on in the slide, but government pensions are generally taxable in the originating country. But there is always exceptions. We're giving you the majority, but there is always the minority. So that is not a cut and dry. But interestingly, the NHS, local educational authority, are public bodies but not considered Crown servants. And again, this is subject to some exceptions, but generally people that work for an NHS trust will not be considered Crown servants for the purposes of UK government service in taxation. And it is important to check the income source and the treaty each and every time with somebody you may think is working under government service or receiving a pension from a previous government service role.
Thanks. So capital gains tax, I said we'd talk about it a bit more. As a non-resident, you are required to report and pay tax on any disposals, so that's sales and gifts and other types of disposals of UK land, whether that land is held directly or indirectly. For example, you've got property sitting within a company and you sell shares. You've got to file within 60 days of making that disposal. It used to be 30 days, so thank goodness that was extended, because that put a lot of pressure on the accountancy body. And also, non-residents have got to file whether any tax is due or not. And interest and penalties will be charged if returns are filed late. So these rules first came in 2015. Most people, when they had to file a return, didn't have any tax to pay, but HMRC could still raise a penalty of £1,600 per person per property if they failed to file a nil return. You can imagine this had us all in absolute uproar for quite some time, to be honest. There was some movement. I think they reduced the £1,600 down to £700. But even so, we spent a lot of time appealing penalties, and thank goodness when the rules were extended to UK residents recently, they made a bit more of a publicity thing about it. Anyway, you can tell it's a bit of a bugbear of mine. So non-residents, if they're thinking of disposing of property, let us know as soon as possible. So direct sales of residential property, let us know. That's the same as residents, but also direct sales of commercial property. And that is different. UK residents don't need to report that within their 60 days. And then the sales of, say, shares in a property-rich company. Typically, other assets that you sell are not normally subject to UK tax. So, if you've got some UK shares, for example, typically those won't be subject to UK tax. However, there's this very important anti-avoidance rule that if you return to the UK within 5 years, then disposals that you made in that intervening period may become taxable in the year of return. And if I give you a quick example there, you might make disposals of £3,000 a year, thinking there's no capital gains tax to pay on that because £3,000 is the annual exempt amount at the moment. But because they're not within the scope of tax, by the time you return 4.5 years later, you've got £12,000 worth of gains, which are all suddenly taxed in the year of return.
Just quickly, Alex, just for a bit of clarity on that, when you say 5 years, are we talking 5 tax years, 5 calendar years, 5 years from
it's 5 years of non-residence. So if you can split the tax year, it's 5 years from the date of your split. And if you can't split the tax year, it's going to be 5 years from the end of the tax year.
Lots of stuff. Right, the good stuff. Remote working abroad. Let's have a look at this, as I'm sure this is going to be quite a interject for a few people, especially since the hybrid work week has come into play, and it's just very readily accessible to work remotely these days. So we've got a poll, guys. All good fun, very interactive. Everyone jump in. I'm just going to read out a scenario for you, and I would be delighted for your input on this and your thoughts. So, Mrs. Thebus has had enough of the British weather, haven't we all? Just have a look outside. And she decides she'd rather work from her holiday home in Italy. The dream. After 6 months, she decides the continental way of life is far more suited to her, and she agrees with her employer to work remotely, permanently in Italy. She continues to be paid by her UK company in pounds and has PAYE deducted at source by her UK company. Now, my question to you is, can Mrs. Thebus assume that all of her tax obligations have been met? Okie dokie. I think we have all our answers with us. So, yeah, we've got a couple of people that said yes. The majority is saying no. So the answer would be no. She absolutely can't assume that all of her obligations have been met. And we're going to explore that on the next slide for the reasons why. Lovely stuff. So the reasons that it wouldn't be as cut and dry as that is because employees and the self-employed are taxed where they work, not from where they're paid or where their employer is based. Someone who works in multiple countries for short periods of time is likely to qualify for treaty exemptions. However, employers may still have an obligation to report even if no tax is due. So it's not as it's really not a straightforward scenario. Now, if a UK employer sends you to work overseas, they will likely help you to get your overseas tax right. If they're regularly sending people out there on secondment to various other territories, they usually have a system in place that they will assist you through that, or at least for a period of time so you can get comfortable with it. If you choose to work remotely overseas, like Mrs. Thebus, because the way of life is just better, then chances are your employer won't help you, and it is down to you ultimately to make sure all of your obligations are met. Now, more than just tax needs to be considered with remote working, and this is stuff like national insurances, social securities in the country you're working in, payroll requirements, employment law, visas, yada, yada, yada. So it's not as cut and dry. I'm not putting anybody off because it sounds great. I'd rather go and work in Italy, don't get me wrong. But it is, again, going back to the Misty example, it is a preemptive decision. You need to get advice before you go. You need to do a lot of research, and you need to consider a lot before you go.
I'm gonna jump in with an example here, because I find people are quite shocked when they say, "Oh, but I'm still paying tax for my it's my UK company, so I'm still paying UK tax. So why would I need to pay Italian tax? It doesn't make any sense to me. Everything's the same. I just happen to be in a different country." So I like to throw it back and give an example. So so Bridie and I do a very similar job. We work in the UK, but let's say I'm employed by Lark and Gowan UK and Bridie is employed by Lark and Gowan Cayman Islands, and there's no personal taxes in the Caymans, so Bridie doesn't pay any tax out there. Is it fair that I have to pay UK tax on my salary, but Bridie doesn't have to pay any tax on her salary when we do the same job and both live and work in the UK? Of course it's not fair. And if those were the rules, then every company in the world would set themselves up in a tax-free jurisdiction and none of us would pay any tax. So that's why.
Absolutely spot on. Absolutely spot on.
Great. I have another example for you here that I've written into the slides that I think is helpful to refer to. So this is a self-employed person this time. So Mario is self-employed and normally resident in the UK, but as part of a project, he's been asked to go and work in Japan for Peach Plumbers Limited. He's been given accommodation out there and will help the business grow over the next 3 years. He breaks UK resident. He doesn't spend more than 30 days in the UK. He doesn't work whilst he's here. He does all of his work in Japan, but he invoices Peach's Plumbers Limited in the UK, as he always has done. He invoices them in sterling and they pay him directly into his UK account. Hopefully, what you are now realising from what we said is that it doesn't matter where he is paid from. It's all about where his work is carried out. And because that work is carried out in Japan, he is taxable in Japan. He doesn't need to report that income in the UK at all, but he does need to probably get a Japanese accountant and make sure he's meeting any tax requirements out there. As an aside, it's also worth noting that because he's not working in the UK, he's not going to have any net relevant earnings for things like pension contributions and national insurance contributions. And we're going to touch on those a bit later as well.
Thank you, Alex. And if anybody gets the reference, the deep down reference in that example, I'll be really happy with that. So other points to consider beyond tax. I appreciate this is a tax heavy webinar, but there are other points just to think about. So UK pension income. So where a pension is taxed very much depends on the type of pension you're receiving. We touched on government service before. So there are 2 articles in all treaties, I believe, between the UK and those territories. One is for pensions and one is for government service. Now, government service covers working abroad whilst for the working under the Crown, but pensions received from government service, and they are taxed very differently. So usually non-government pensions, so if I didn't work for the Crown, my employer pension or my private pension would be taxed generally in my country of residence under the pension article. Generally, broadly, all of those things, there's always an exception. And usually this covers social security as well. Now, government pensions are generally taxed in the country of origin, unless specified, and usually the thing that makes it taxable in the country of residence rather than the arising country is if the recipient was a national and resident of the other territory. That seems to be the one that tips you into the other taxing territory. I cannot stress enough that these points are really nuanced and they vary between country and country. So it is as I can give you the majority of scenarios, but check the treaty every time and seek advice before you move, so you get a full understanding of what your obligations are going to be, because it's not a choice of where you get taxed, it is dictated by these documents. And you need to be careful with lump sums. They are something else. They do what they want. So lump sums are different. They're not treated as periodic payments. So be mindful of that. They're not always taxed under pension articles unless specified very specifically. So yeah, that can be quite a game changer. And there's a lot of advice given for when these can be taken and when they're most beneficial. So just be a little bit wary of those.
Great. I'm going to talk about pension contributions. Just to clarify, Bridie was talking about income when you're taking money out of your pension. This is contributions that you're paying into it. So if you've got an existing pension policy, you can normally continue to make payments for up to 5 years, but you should always check with your pension provider. You may not get tax relief on those contributions though, because your tax relief is tied into what's called your net relevant earnings, which is broadly employment income and trading income. Now, if you've moved overseas, you're probably not going to have very much of that. You might have some rental, you might have some investment income, but they are not net relevant earnings. So you might be limited to what's called the stakeholder amount, which is where you pay £2,880 into your pension, and the government will top that up to £3,600. It's still better than nothing, but just watch out for that. It's also worth a note saying that pension funds may not open a plan for you if you are non-resident. So if you are moving overseas and you don't already have a plan, it might be worth starting a pension plan before you go whilst you're UK resident. And my final point on this is anything to do with pensions, please speak to a financial advisor.
Absolutely. That is a huge recommendation. Right. So I'm going to have a quick slide on disregarded income. Now, this is a very special kind of rule all on its own, which is if you're a non-resident, you can benefit from the disregarded income rules only for non-residents, where broadly, again, loving that word today, UK dividends, interest and state pensions are excluded for tax purposes in the UK. But you forfeit your personal allowance in order to have these things disregarded. So a good example of this would be somebody who, for example, has, let's say, £15,000 worth of rental income and £200 of dividends. It would be much better for them to claim the personal allowance because this rental income isn't included as part of the disregarded income rules. So you'd want your personal allowance, assuming you are entitled to one, going back to previous slides, and have a lot of that covered by your personal allowance, and then tax the rest as it comes. However, someone flip that round with £15,000 of dividend income and £200 of rental income would be much better off under the disregarded income rules by just having that dividend just completely ignored for tax purposes and paying tax at 20% on the £200 worth of income. So it is an incredibly beneficial rule if your income in the UK consists mainly of those sources. If you have your own personal service company in the UK, for example. So yeah, some instances really can be quite a big difference to your tax position in the UK. So that's something just to think about.
Moving slightly away from tax, but still all linked and still relevant, child benefits. So if you move overseas, you can no longer claim child benefits. And if you are still claiming it, then HMRC will ask you to repay it, which we all know is from the furore over high income child benefit charge is very unpopular. If your spouse is still in the UK and you move overseas, then your spouse can still potentially claim child benefit. And again, like with somebody who is UK resident, you've still got to consider the high income child benefit charge rules. So that's where the highest earner in the household, if they earn more than 60,000, used to be 50,000, but now 60,000, then the child benefit starts to be clawed back. The advantage that you've got with expats here is that the 60,000 threshold is based on your UK adjusted income. So you might be earning £100,000 overseas, but if your UK income is only 1,000, then you can still get your child benefit and not have it clawed back. I've just put in the bottom there that there is a consultation. So child benefit could all change in a couple of years. So we'll have to wait and see what comes out of it then.
Lovely stuff. So student loans, love them, super exciting. Right. So you will still, oh God, I'm always the bearer of bad news. You will still need to make student loan repayments when you're working abroad. Boo. Thresholds for these repayments will be, as usual, dictated by your plan type, but also the country you're working in. So HMRC have published tables so you can understand your obligations for plan types, countries, and what the thresholds are for reporting. It is your responsibility to update the student loan company. They're not going to follow you around. They're not going to try and find out. And you need to let them know what your offshore income is. And that can be completed on the online form. And if you fail to tell them, they are completely within their rights to apply a fixed rate deduction in the absence of any information that you provide them. So just something again.
Ouch. National insurance. We all hopefully are aware of national insurance. It's not called national insurance in other countries, it's called social security, just watch out for. But if you have employment income that remains taxable in the UK, then you're probably still going to have to pay some class 1 national insurance. If you've got trading profits in the UK, you're probably still going to have to pay class 4. But if you've moved permanently overseas, you're not working in the UK, not trading here, You may not have any national insurance that you have to pay, so you might voluntarily want to pay either Class 2 or Class 3. Class 2 is about £150 a year, and Class 3 is about £750 a year. So there's quite a big difference, and it's not a choice. You're either entitled to one or the other. And the reason to pay voluntary contributions is because these count towards your state pension. So if you don't have 35 years worth of national insurance contributions over your working lifetime, then you will get a lower state pension when you retire. And for most people, paying an additional £150 a year is a complete no-brainer. They're always going to get more than that back. If you're in the £750 a year mark, then it kind of depends, and we'd be recommending people contact the Future Pension Service. You can get a tailored prediction of what your state pension is likely to be and how many years you need to top up, and if it's worthwhile.
Just another point quickly on that is so voluntary contributions, Class 3 and Class 2 does not entitle you to certain benefits in the UK, such as job seekers and maternity allowance and stuff. So it's not just to do with your state pension. It has other knock-on effects as well, but thus voluntary NIC's Class 1 is, we don't talk about that.
Great.
Thanks, Bridie and Alex, for stepping in as I disappeared, and great presentation, and obviously demystifies hopefully a lot of the residency complex areas. Obviously we've talked about the UK tax aspects, but if you're overseas, don't ignore the overseas tax aspects, and we do have a link with a national or global firm of accountants called Prime Global that we can put you in touch with regarding that. So I think, Alex, you've got a question that's been sent in advance that you're going to answer?
Yep. So the question that I had in was, we've got somebody who's moving to Spain, and we've got a UK limited company, and we've got income from rental property in a caravan site. So if I deal with the rental property in a caravan site, that's very much UK land. The UK retains the taxing rights. So you'll still need to file the UK tax return to report that income, pay tax on it. Spain might want to tax that income as well, because you're resident in Spain. But if in that scenario, Spain would have to give a credit for the UK tax. And let's say the UK tax is at 20% and the Spanish tax rate is 35%, then you would end up paying a top up 15% in Spain. So it's not double taxation, but it's double reporting. Unfortunately, if the Spanish tax rate is less than the UK tax rate, so let's say you're paying 20% in the UK and 15% in Spain, Spain won't give you a 5% refund, and the UK won't give you a 5% refund either. You know, you'll end up paying the highest rate across the two countries. So that's just something to be aware of. As I say, not double taxation, double reporting. Companies. So companies are much harder, and I'm afraid there is no one size fits all. Companies do have residence rules in the same way that individuals do. So a company is tax resident where it's incorporated or where it is centrally managed and controlled. If you have a UK company and it is being centrally managed and controlled from Spain, then there's the potential that you've made it dual resident, in which case you look at the treaty. What's the tiebreaker test? The tiebreaker is where is effective, i.e. day-to-day management. So central management is a bit more strategic, effective is day-to-day. If control moves from the UK to Spain or any other country, then potentially you're going to export the company, you're going to make it a non-UK resident company. There could be exit charges, there will definitely be paperwork, and there could be tax overseas. It may not be a bad thing to export a company, because you may end up paying less tax overseas, but it's not going to be simple. It's very much going to depend on the type of work that the company is doing, what intends to be done abroad, a UK property company is going to be very differently treated to a consultancy personal company. How long you're going to be overseas, what future income you're going to receive, who else is involved with it, and that's why I say there's no one size fits all. We deliberately haven't done any slides on it because it's just not possible to give a general opinion. It's also really important to get advice in the other country, because that other country may not care about your UK company. I've seen Portugal just isn't interested at all. So it may be managed in Portugal, but if they're not interested, your default is you've got a UK incorporated company, so tax remains in the UK. France, I know, is completely the other end of the scale. France is very strict on offshore companies, so non-French companies. So you'd need to take careful advice in France on that side. And again, I'd reiterate Liz's words, we refer back to Prime Global, so we can link you in with accountants there. Right. We have got to the end of our session. I'm afraid, I'm so sorry that we didn't have time for taking more questions, but any questions that people have submitted, we will get a copy of them, so we will try and reply to them. Also, if you've thought of a question and haven't submitted one, please do send it through inquiry@larking-gown.co.uk. Mention Bridie and myself, and it will come through to us. We're expecting to be completely inundated, so if you don't hear back straight away, please bear with us, but we will try and get back to you. Hopefully this has been of interest because you're leaving the UK, but actually we're going to run another webinar on the 26th of June about coming to the UK. So that might be relevant for your friends. It might be relevant for you in a few years' time if you leave and then come back. So we'd love to see any of you there. And otherwise, thank you very much for attending.